Welcome to Talk Tickers. So, Six Flags just dropped its third quarter results for 2025, and man, it was a roller coaster of a quarter, and not one of the fun ones. We're talking about a post-merger story that just hit some serious turbulence, with a massive earnings miss that has everyone asking, what in the world just happened? Let's break it all down.
All right, let's just dive right into the headline numbers from their call on November 7th, because they were a real shocker. They came in way below what Wall Street was expecting, and you can bet the market did not love it.
Okay, so the number that just grabbed everyone's attention was this, a staggering loss of $11.77 per share. Now, to put that into perspective for you, the consensus on the street was for a profit of over $2. That is just a mind-blowing miss.
And this table here really paints the full picture. I mean, look, revenue was only a little bit off, right? And Adjusted EBITDA, that's basically their core operational profit, was pretty much flat compared to last year. So what on earth caused that absolutely massive earnings miss on the bottom line? Well, it all comes down to a huge one-time event.
Yeah, so here's the key. It's super important to understand this loss wasn't from the parks just bleeding cash day to day. No, it was a massive $1.5 billion non-cash write-down. This is basically an accounting move where the company says, you know what, after this big merger, some of these assets we have just aren't worth what we thought they were. It's a paper loss, but a huge one.
So what's really fascinating is how management tried to frame these results. They didn't just throw their hands up. Instead, they basically told a story. You could call it a tale of two parks, where the company kind of has this split personality right now.
So it breaks down like this. On one hand, you've got your star performers. These parks make up about 70% of the profits. Their attendance was actually up 5%, and their earnings grew by double digits. Pretty good. But then you have the underperformers. They're about 30% of the business, but attendance is falling, profits are falling. You can see the problem here. A really strong core is being dragged down by the rest.
And this quote right here from the CFO, Brian Witherup, is a massive signal. They aren't just saying, oh, we have a problem. They're telling us their plan. They're going to monetize these parks, which is just corporate speak for we're going to sell them. This means we could be looking at a much leaner, more focused Six Flags down the road.
Now, on top of that whole portfolio problem, management also kind of owned up to a few other issues. They said attendance started to slow down in September and then took a pretty big 11% hit in October. They also admitted their early year ads didn't really deliver, and that in some places they just hiked prices way too fast for customers.
So, with all of these challenges piling up, it's really no surprise that their forecast for the rest of the year got a pretty serious haircut.
And here it is. Reflecting all these struggles, they basically slashed their full-year guidance for Adjusted EBITDA. They started the year thinking they'd do around $1.1 billion, and now they're saying it's going to be somewhere between $780 and $805 million. That is a gigantic cut.
And looking ahead to the final quarter, the holiday season, they're setting a much lower bar. They're now bracing for attendance to be anywhere from flat to down by mid-single digits. It's a very clear sign that they're trying to be a lot more cautious.
But just when the story seemed to be all about these operational struggles and guidance cuts, an incredible plot twist emerged. A whole new variable just entered the equation, adding a completely different layer to this whole Six Flags saga.
That's right, you heard that correctly. An activist investor group, led by the well-known firm JANA Partners, has swooped in and taken a major stake in the company. And they brought along a pretty famous partner, football superstar Travis Kelce.
And look, this is way more than just a celebrity endorsement deal. This group has a nearly 9% stake and a very clear plan. They want to get their hands dirty, helping with branding and marketing, and they're also pushing the company to move even faster on selling those weaker parks and putting that cash to better use.
The CEO, for his part, seems to be embracing it. He called the whole thing constructive and pointed to the insane amount of buzz this news generated. You can tell the company is definitely hoping to ride this wave of publicity right into the 2026 season. So, let's put it all together now for our next call. You've got the really bad news from the earnings report, but then you had this unbelievable activist wildcard. So what does all of this actually mean for the stock?
The stock definitely took a hit after this report, which tells you the market is pretty nervous. So the big question for any investor is this a dip you should buy, or is it a sign of even more trouble ahead?
Our view here at Talk Tickers is that the stock is probably going to be stuck in a rut for a little while, likely trading somewhere between $17 and $20 a share. The market is basically in wait-and-see mode. We think next quarter's results will be in line with their new, lower forecast, and everybody's going to be laser-focused on the early sales numbers for 2026 season passes.
So what could actually change the story? What could break this stock out of that range? Well, here are the key things we're watching. How fast are those 2026 season passes selling? Can we get more details on this Travis Kelce marketing plan? Do they announce a sale of one of those parks? And, of course, the big one, do they announce a new CEO? Any of those could be a major catalyst. So our final rating on Six Flags for now is market perform. Listen, this company has a really tough turnaround ahead of it, and there's a serious risk they might not pull it off. But that risk is balanced by the potential upside from these new activist investors and the smart plan to streamline the business. For now, it's a classic story of risk versus reward.
This is not financial advice.